What would happen if the largest economy in the world defaulted on its debts?
In the talks surrounding the debt ceiling,
a failure of the United States to honor all of its debt, financial and economic chaos would ensue.
It sounds scary, but it's possible.
But we've got a lot of work to do in a short amount of time.
And there is a chance it could be as early as June 1st.
It would be a very serious circumstance. We didn't pay our debt for the first time.
What is actual default? That is potentially catastrophic.
The president and the speaker are the keys to the deal.
Essential that the debt ceiling be raised in a timely way. A failure to do that would be unprecedented.
Have we hit a serious roadblock, or is this political posturing? Is this a stunt?
Negotiations in Washington over raising the debt ceiling have been sporadic. A failure to increase the debt limit could result in a catastrophic default, which would likely force the Fed to adjust its strategy. This situation has left the bond market in a state of uncertainty, as sentiment is torn between a stronger than expected economy and a political deadlock that could severely harm it.
How are you explaining the possibility that American democracy could cause a global financial crisis?
That'd be a serious problem. I can't guarantee they wouldn't force a default.
Our current projection is that in early June, we're unable to pay our bills unless Congress raises the debt ceiling.
Ongoing debate within the Fed about the next course of action, with opinions split between pausing rate hikes and tightening further. Fed Chair Jerome Powell indicated he's likely to keep rates steady next month, suggesting the central bank has some room to observe the impact of its actions given uncertainty about the economy's future. Nevertheless, even if the Fed decides to pause its rate hikes next month, it might not necessarily alleviate the pressure on the bond market, since rates across treasuries are still considerably below the Fed's current policy band. If the US defaults on its debt payments, it could have serious consequences not just for the US economy, but for global financial systems as well.
A couple weeks away, but if you look at the timeline to pass something in the House and pass something in the Senate, but there is no movement.
You need to stop playing Russian roulette.
Russian roulette with the economy.
Market turmoil, downgrading of US credit rating, higher interest rates, global economic repercussions, damage to the US dollar, government shutdowns, and a recession with more job losses and decreased economic output.
You have markets get volatile, maybe the stock market go down. We better be very careful.
Wait a second. Before going any further, some may be wondering, what on earth is the debt ceiling?
The U.S. has a weird thing called the debt ceiling.
The debt limit, often referred to as the debt ceiling, is the maximum amount of money that the United States government is authorized to borrow to meet its existing legal obligations, including Social Security and Medicare benefits, military salaries, interest on the national debt, tax refunds, and other payments. The debt limit does not authorize new spending commitments, but allows the government to finance existing legal duties that Congress and the president have agreed to in the past.
Which is just a limit on how much debt the country can take on. The national debt is at an all-time high.
Now, the concept of the debt ceiling was created in 1917 to simplify the financing of World War I. It became a political issue in 1953 when Senate approval was delayed in an attempt to restrict President Eisenhower's spending on the national highway system. Over the past quarter century, the debt ceiling has increasingly become a tool of partisan politics, leading to government shutdowns and a historic downgrade of the US government's credit rating.
In the last 20 years, the US has borrowed more and more money.
The US Congress sets the limit. If the debt limit is reached and not increased by Congress, the Treasury Department is unable to issue new debt and could default on its obligations, which could have severe economic consequences. To avoid this, Congress has always taken action to increase the debt limit when necessary.
If the national debt reaches that limit, the US might not be able to pay its investors.
So to further understand this, we need to ask, what is the history that led up to this tense standoff? The history of the US debt limit is intertwined with the history of federal borrowing and the development of fiscal policy in the United States. This history offers 5 insights into the evolution of debt limits from a tool of fiscal accountability to one of fiscal policy, and most recently to a subject of political debate. Origins of US public debt.
Have just 2 more days to raise the nation's debt ceiling and avoid a catastrophic
default on its loans, which could create turmoil in the U.S. economy and worldwide.
In the early days of the United States, the federal government incurred debt to fund extraordinary expenses such as wars and economic crises, rather than regular operating expenses. The newly formed country had substantial debts from the Revolutionary War. This debt was managed by the Secretary of the Treasury, Alexander Hamilton, who considered a national debt a national blessing if it was not excessive and was properly funded. From this perspective, the federal government began to issue bonds for borrowing money to meet these extraordinary costs.
This isn't some damn game.
The evolution of debt management. Prior to the First World War, Congress authorized each separate debt issuance, approving the terms and purpose of the debt. Now, this provided a higher level of congressional oversight and control over federal debt, but it was a time-consuming and inflexible process.
Neither side wants to back down. Catastrophe looms.
The birth of the debt limit. To provide more flexibility in financing the U.S. involvement in World War I, Congress passed the Second Liberty Bond Act of 1917, which established aggregate limits, or caps, on the amount of debt that could be issued, effectively creating a statutory debt limit. The role of debt limit over time. Over the years, the form and nature of the debt limit evolved, and it gradually transformed into the more comprehensive limit on nearly all forms of debt that we know today. During the mid-20th century, as government borrowing to fund regular operating expenses became more common, the debt limit became less of a tool for fiscal accountability and more of a tool for fiscal policy. Lawmakers have at times used the need to raise the debt limit as leverage to achieve other policy goals or to enforce fiscal discipline. And the debt limit today.
The entire basis of the Republican strategy is we're going to shut down the government or cause economic chaos if we don't get 100% of what we want.
In recent years, the debate over the debt limit has increasingly become politically charged.
No new taxes and no clean debt ceiling, but everything else is on the table. I want to be reasonable, I want to be sensible, but more importantly, we want to be responsible.
The limit has been raised or suspended numerous times, often following extensive and contentious negotiations among lawmakers.
President Biden has presented a detailed budget that does cut deficits by $3 trillion over 10 years.
This politicization of the debt limit has led some to call for changes in how the limit is administered, including proposals to abolish the limit entirely or to automate increases in the limit. While some experts argue to abolish the debt ceiling, previous administrations have rejected several strategies for circumventing the limit. One suggestion that has gained attention is invoking the 14th Amendment of the U.S. Constitution, which states that the public debt of the federal government shall not be questioned.
Using the 14th Amendment would allow the United States to continue to pay its bills on time.
The 14th Amendment to the United States Constitution was adopted on July 9, 1868 as part of the Reconstruction Amendments in the aftermath of the Civil War. It contains 5 sections addressing citizenship rights and equal protection under the law.
I'm looking at the 14th Amendment as to whether or not we have the authority. I think we have the authority.
Prevent an economic catastrophe and prevent devastating cuts to some of the most vulnerable people in this country.
The amendment section 4 reads as follows. The validity of the public debt of the United States authorized by law, including debts incurred for payment of pensions and bounties for services in suppressing insurrection or rebellion, shall not be questioned. The primary purpose of this section was to ensure that the debts incurred by the United States during the Civil War would be honored. However, it has more recently been cited in debates about the federal debt ceiling. Some interpret this section as meaning that the federal government must always honor its debts, thereby deeming it unconstitutional for the United States to default on its obligations.
It should be exercised if necessary.
So, let's zoom back into the present.
Look, we can't be spending more money next year. We have to spend less than we spent the year before. It's pretty easy.
The United States is approaching its federal debt limit of nearly $31.4 trillion, with Treasury Secretary Janet Yellen warning that the country could default on its financial obligations as early as June 1st, 2023.
Yes, early June is when we project that we will run out of cash.
This situation, commonly referred to as the X date, has placed the nation's debt ceiling into focus. Contrary to the impression that the term debt ceiling might give, this limit is not a restriction on new spending, but instead a cap on the government's ability to borrow funds to pay existing bills. U.S. Treasury Secretary Janet Yellen has warned lawmakers that the Treasury Department's capacity to avoid breaching the debt ceiling through special accounting methods may be exhausted by early June. This warning follows a trend of decreasing resources, with the Treasury revealing it has only about $88 billion of its authorized extraordinary measures remaining as of the previous week.
That's it. We've been using extraordinary measures. Our ability to do that is running out.
Despite ongoing discussions between President Joe Biden and Speaker Kevin McCarthy, progress towards a resolution remains uncertain.
We already have taken default off the table because the House Republicans passed a bill that raised the debt ceiling, limited our future spending, saved taxpayers' money.
Politicians from both major parties acknowledge the need to raise the debt ceiling given the sizable gap between government spending and revenue.
If they fail to do it, we will have an economic and financial catastrophe.
The Republican-led House of Representatives, which took control in January, favors coupling a debt ceiling hike with spending cuts. On April 26, they passed a bill to raise the debt limits by $1.5 trillion, offset by the $4.8 trillion in budget deficit reductions over the next decade. However, President Joe Biden insists that any raise in the debt ceiling should not be contingent on any other actions.
So how could we responsibly lift the debt ceiling? Our spending is out of control. That $6 trillion extra dollars the Democrats spent brought us inflation.
Treasury bills maturing after the potential so-called X date have been showing a significant yield premium, reflecting concerns about non-payment. Additionally, the cost of insuring U.S. debts against non-payments has soared in recent weeks. Despite this, other markets have remained more optimistic, a stance that could change if the debt ceiling situation worsens. Even if a deal is reached before June, the debt showdown may stoke market volatility. Yields for some Treasury bills maturing just after the X date have already started to rise, and volatility may cycle through assets if the debt ceiling is repeatedly suspended. While Yellen pledges to update Congress as more information becomes available, the exact timeline for when the Treasury will run out of extraordinary measures remains uncertain.
We would simply not have enough cash to meet all of our obligations.
If the X date occurs in the first week of June, the practical deadline may be as early as May 26th. Meanwhile, investors and strategists are observing multiple factors to gauge the level of concern. A key area of focus is the yield curve for bills, the shortest dated Treasury securities, with noticeable upward distortions suggesting increased investor concern. April saw a notable shift towards shorter maturity Treasury bills. Additionally, credit default swaps for the U.S. government, which acts as insurance for investors in cases of non-payment, have become more expensive, surpassing the cost of insuring the debt of Greece, Mexico, and Brazil. The U.S. government's cash balance is a critical factor, fluctuating daily depending on spending, tax receipts, debt repayments, and new borrowing proceeds. It is currently below $200 billion, and getting close to zero could present a problem.
I don't want to consider emergency options.
However, a solution ultimately needs to come from Washington, and time is running short. Biden, McCarthy, and other congressional leaders need to strengthen budget negotiations to avoid a default. Despite the uncertainty, many in the financial markets still hope for a deal, as historically has been the case, even in the situations of severe pressure. A potential default could have severe repercussions, including delaying payments to the Social Security recipients, military personnel, medical providers, and Treasury bondholders. Moreover, a failure to repay bondholders could lead to credit rating agencies downgrading U.S. debt, causing increased borrowing costs and negative economic impacts. But don't just lose hope yet. After all, history tells us that even under the most intense pressure, a deal usually gets made. So will history repeat itself this time?
How worried are you about the debt ceilings?
And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic.
The odds are in the United States' favor. The U.S. has never defaulted on their debts. There is a general expectation that lawmakers will eventually find a resolution to the debt ceiling stalemate, avoiding a devastating default.
This would be really the first time in the history of America that we would fail to make payments that are due.
However, this is not to be taken lightly. The economic effects of this dispute, combined with the Treasury's subsequent efforts to resume normal borrowing operations, could lead to significant impacts. Specifically, once the debt limit is resolved, the Treasury will need to rapidly replenish its cash reserves through a surge of Treasury bill sales. This could quickly draw liquidity from the banking sector, elevate short-term funding rates, and put additional pressure on an economy that may already be on the brink of a recession.
Now it's time for the other side to move.
The thing about markets is always remember, panic is the one thing that scares people. They take irrational decisions.
Despite these concerns, a resolution to the debt limit standoff seems increasingly likely, which will lead to a significant increase in the US cash stockpile. However, this will have implications for liquidity across the financial system, as any excess bills issued by the Treasury will result in funds being drawn from the private sector. The Fed's Reverse Repurchase Agreement Facility, the RRP, is another significant factor to consider. At present, the RRP holds over $2 trillion, which, if it decreases while the Treasury account increases, could result in a lower drain on reserves. Experts predict that the money funds will continue to keep cash in RRPs, which could lead to a substantial drain in bank reserves when the Treasury's cash balances rises. The general sentiment is leaning towards a risk-off stance, with concerns about the scarcity of reserves, which is central to many trades on Wall Street. High repo rates could have serious implications for hedge funds and other borrowers. The Treasury is aware of the potential market turbulence that could be caused by a sudden influx of bills and has been advised to monitor markets closely and not to replenish its cash balance too quickly. The resolution of the debt ceiling standoff is anticipated to significantly affect liquidity in the financial system. This could lead to a drain on bank reserves and potentially disrupt risk markets, slowing economic growth.
This is not good. And people should remember the American financial system is the foundation to the global economic system.
The subsequent strategies employed by the Treasury and the Fed's RRP facility will play crucial roles in how these scenarios unfold.
No one should assume that the Fed can protect the economy from the potential to pay our bills on time.
While some experts argue for abolishing the debt ceiling, previous administrations have rejected several strategies for circumventing the limit.
But yes, at the end of the day, if it gets to that panic point, people have to react.
Do you think this will be the first time the US defaults on their debt obligations? Please leave your comments in the section down below. Don't forget to like, subscribe, and follow the channel. Thank you so much for watching, and I will see you in the next video.